Hey everybody, Chuck Barone. Thursday, February the 16th, 2023. A colossal day. Lots of important stuff to go over today with you guys. Big numbers. Going to give us what we got today is a pretty good idea of where we're going, at least for the near term. We'll get to all the details, but first I just want to welcome everybody to the show. Thank you guys for your support every day, for watching the videos, your comments and likes. We really appreciate your support, guys. Markets today. Not a good day for stocks. Stocks down across the board as reality on inflation and rates sets in, guys. The Dow down 431 points today. S&P down 57. NASDAQ down 214. I mean, this is not like crash stuff, but this is a significant reversal from the optimistic kind of vibe we had earlier this week. Now, of course, everything turning negative. Important data. I can't wait to go over it all with you guys. Today in the bond market, bonds, well, selling off a little bit. Yields up. 10-year up 3 basis points, 3.84%. The 2-year not bumping very much, just up 1 basis point to 4.64%. So you got an 80 basis point inversion here. It's almost to 1%. I mean, it was higher earlier this week, coming back a little bit. But this is typically, as we know, when the bond market inverts. And when I say inverts, it means short-term rates are significantly higher than long-term rates. Usually it goes like this, right? The shorter the term, the lower the rate, the longer the term, you get a reward for risking your money for the longer time. Well, now we have a bond market that's inverted. So short-term, 2-year, higher, 4.64, than the 10-year, which is 3.84. So you got 80 basis points inverted. Usually it's the other way around, right? So the inversion, well, it's not always 100% accurate. The inversion does not always tell us recession's coming. But every recession, prior to that recession, we had an inverted yield curve. So it's a pretty good indicator that there's a recession coming. And the rest of the story goes, the deeper the inversion, typically the deeper the recession. So it doesn't look like we have good economic news coming down the road. I think that we'll have, this has been such a fluid situation lately. This is the market and the whole world still all upside down from the COVID and the reaction to it worldwide. It's still hasn't found its sea legs, so to speak. So the market's staggering around, no up or down, real guidance as far as a trend in the market or, something we can see clearly. It just seems so cloudy right now with every day the vibe in the market changes. The dollar today up small, but it was up enough to get up over a 104 on the index today. So the dollar rallying, building strength back up. It's not anywhere near its high. It was one point in the cycle up over 109, but it's rallying back up from a 103. So the dollar holding its own against world currencies. As a result of the dollar strengthening a little bit today, as we've talked about many times, the correlation between the strength of the dollar and the strength in gold and silver, dollar strengthens, typically gold and silver weaken, and vice versa. Well, with the dollar up today, metals down small, gold down 20 cents an ounce, $1,836 and change, silver down a nickel, $21.56 per ounce. These are still pretty solid prices. It's a little disappointing to see them coming back this far, but the events in the world sometimes get in the way of our profits, don't they, guys? But markets, metals, gold and silver still holding their own, in my view. Oil today, down small, down 55 cents a barrel, $78.04 for a barrel of West Texas Intermediate. Oil just been in that trough, guys. The trough for most of last year, for a big portion of it, was between $80 and $85 per barrel. Then it broke up to close to 100, then it went back, crashing back down, and now it's kind of been sticking in this trough between $75 and $80 per barrel where it's been sitting and still is. Bitcoin today, the rally goes on, man. Bitcoin having a pretty good week this week, up $419 last time I looked, $24,518 for a Bitcoin. Go Bitcoin, man. I'm glad for the people that watch this show that are holders. I know there are several. Glad to see this making a rally for you guys. This is not what I would call a defensive position, however, so if you can, maybe take some of the profits if you have some, and just keep some powder dried. I'm not saying invest anywhere else. I'm just saying keep some cash on hand, because there's going to be some bargains coming when we come out of the other side of this friggin' craziness. News you need today. Well, it's a couple of big items, guys. First one, jobs, 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 man. Jobs just continuing to stay sizzling hot. Claims coming in today, 194,000 versus 200K expected. There's still 1.9 jobs for every person looking for one. I know these numbers are fudged a little bit, but the truth is, the jobs market's still hot. We read about, these big tech layoffs, Google and Meta and all these different tech companies laying off people. I did a little research today. I saw that tech basically is about 6% of the economy. So, of the employment economy. So, guess what? They laid them all off. It really would only create a small hole in the whole employment pictures. So that's why I think you're seeing this conundrum where everything we're reading in the media, jobs being cut, jobs being cut, jobs being cut, and then we get jobs reports that show the job market's super hot and there's plenty of jobs out there for people who want them. Crazy, but this jobs report, guys, just increasing the pressure on the Federal Reserve to maybe even get a little more aggressive. For certainly, they're going to stick with the original plan of raising a quarter. I still think there's another quarter behind that. We're going to get over 5% on the Fed funds rate. That's, in my mind, a certainty now. The Fed believes that this jobs market is a huge driver of a big part of this inflation. And they're, in spite of their best efforts with interest rates, and really, they've been pulling cash out of this economy pretty strong too. According to M2 numbers, $500 billion M2 dropped. Now, don't get me wrong, that's nowhere near the amount it increased during the big flooding of money bullshit they did. But just to see it going backwards a little bit, okay, Fed may be doing a little bit of their job here, at least trying to appear like they are, right? So along with that sizzling hot employment number, today we get P.P.I. Now, that's the producer price index. Earlier this week, we got the consumer price index, which is the price you pay when you buy something at the register or retail. The P.P.I. is the producer price index. This now showing what it costs producers to create the product, wholesale prices basically, and P.P.I. jumps big, up 0.7% month over month. Top line P.P.I. 6%. They were expecting 5.4%. This is the biggest increase in 7 months since last June. Now remember where we were last June. Inflation was really starting to rock. That turned out to be, at least up until this point, the month where we hit peak inflation, with the top line inflation at CPI inflation at 9.1%. The reason PPI is important, guys, is because it gives us a little bit of an idea of where prices are going to go in the future. Right? So typically, if it costs a retailer 6% more to buy a product he wants to sell or does sell on his shelves, is he going to just take 6% less profit? Hell, in a lot of stores, especially in supermarkets, the profit margins aren't even that high. So these increases tend to get passed along to the ultimate consumer. So PPI shows us a little bit of where we're going down the road with prices, and this PPI number, I don't know if it's an outlier or if this is a trend now, but this PPI number says we're not done with this inflation fight. This is the shocker I've been talking about, where nothing goes in a straight line up or down. Well, here's our shocker for them now. And this also, with these two reports today, just now really pinning the Fed down. Any hopes that anybody had of any kind of pivot this year certainly look just much less likely today than they did just a short time ago. This puts a lot of pressure on the Federal Reserve. It's showing that while what they're doing is starting to work a little bit, They're nowhere near where they need to be. I got a funny feeling we're going to start hearing more Fed hawkish talk. We're going to hear about new terminal numbers. We've already been starting to get some feelers on that, talking about bringing it up an extra half a point to 5.6%. I think, anything's possible right now, guys. These inflation numbers could come roaring back. This hot job market just going to only increase pressure on wages. The inflation picture not looking super good today. That explains how the market's reacted today. They're seeing the writing on the wall here, and none of the news as far as stocks go looking very good. Now, this I thought was interesting. I kind of want to share this with you guys. So we've been hearing all about the Federal Reserve and the government statistics, and we've been hearing certain Fed people talk, and of course a million analysts, myself among them. Well, today I was reading in the paper the CBO, Congressional Budget Office, weighed in today, and what they say is this is pretty interesting stuff. They said that in their estimate, the U.S. economy will stagnate this year. They're not expecting any kind of real recession, but they're not expecting any real growth in the economy this year. They said that at the end of the year, the unemployment rate will be 5.1% from the 3.4 it is today. That's a pretty significant bump. We're talking 50% increase in unemployment by the end of the year. They said that the inflation number at the end of the year, by their estimate, will be 4.8%. I guess that's the top. I don't know if that's the PCE, if that's the top line CPI or core CPI. They didn't really elaborate on what that number was. But they're still seeing inflation being elevated at the end of this year, which is a pretty sad thing to see. And this was the stuff that really got to me, though, is they talked about the fiscal. Okay, so you have monetary, which is the Fed, right? Interest rates, money supply. You got the fiscal, which is the friggin' knuckleheads in Washington who are determined to destroy this friggin' country. So listen to this, guys. According to the CBO, and now they're the Congressional Budget Office, they're nonpartisan, so they're not political here, okay? They said that the total U.S. debt, listen to this, the publicly held portion of our national debt would hit $46 trillion in 2032. That doesn't sound high from the 39 trillion we're already owing, right? But that's the publicly held portion, which today is about 23 trillion. So we're talking basically a doubling in the next 10 years or less than 10 years. The publicly held portion, that would push the total national debt to almost 70 trillion. That would include, unfunded liabilities of the government, right? Social Security, Medicare. They've said, the numbers were just staggering. Social Security, by 2032, if we stay on our current trajectory with spending and revenue, 2032 would see a 20% cut in benefits for people already receiving Social Security. The net interest on that $70 trillion would far exceed what we spend on national defense this year, which was around $800 billion. So the interest on the national debt would be more than $800 billion. And here's the sad part, guys. We'd have to borrow that $800 billion in interest to pay the money, 70 trillion, we already borrowed. I don't know the answer to how we solve this. I'm going to guess it's going to be a combination of pretty painful spending cuts and higher taxes for everybody. But that can't happen, man. We can't have senior citizens who are barely scraping by right now getting a 20% cut in their incomes. We can't have the friggin', makes me want to start swearing, guys. these politicians, and when they talk about cutting spending, they never really talk about it seriously. They don't. Because what they want to do is cut spending and cut taxes for rich people at the same time. Or they want to spend more and cut taxes for rich people at the same time. It's really sad, the state of the nation. And it just seems like, according to the Congressional Budget Office, things are going to get worse. Yay. Now here's a little fun fact. You guys know I'm fascinated with numbers. I thought this was interesting today. We all had a lot of pain last year at the gas pump, paying prices that were outrageous. And we heard a lot of people talking about greedflation. We talked about it on the show. Listen to this number. I thought this was interesting. I saw this today posted. It said that if you made $53,000 per day, $20 million per year, since Jesus' birth, so 2000 X number of years, if you had $53,000 a day from the date of Jesus' birth, you still wouldn't equal what Shell made in profits last year, or in 2022. We already know Shell didn't make the most. Chevron did. Exxon, all these oil companies making these incredible profits this year. We paid those profits, guys. Let's just say it like it is. And you know who's going to be the beneficiary of those profits? They're not going to share it with us and lower gas prices. They're not. The beneficiary is going to be the people who own the stock when they buy back their Brazilian shares of stock, because that's what they do with their profits now, guys. That's how the rich make themselves richer. When I first started voting, stock buybacks were illegal. It was considered corrupt. It was considered price manipulation. It was considered all kind of horrible things. And now that the geniuses, our friends in Washington, and their genius decided that wasn't fair, that they should be able to buy their own shares back. Well, guess what? That's all they do now. That is what they make profits for. Nothing for the community, nothing for their employees, only the shareholders. Yay, shareholders. Anyway, guys, that's it for today. We appreciate your support as always. Sorry for the big negative report today, but it is what it is, man. Hopefully tomorrow we'll wrap this week up. We'll get some good news somewhere. I'll go digging really hard to get it. But again, we appreciate your guys' support. We'll be back again tomorrow to wrap it all up. Until then, guys, take care.